We're calling it now. Today's semiconductor surge isn't a rebound. It's a policy-driven rerouting of compute capacity ahead of Trump's 10% tariff hammer. The lab sees it in the dime maps. This rally is priced on survival, not growth. SMH popped 1.5%, but don't be fooled. VanEck's underlying foundry mix shows 68% exposure to UMC and SMIC, both in the crosshairs of new export controls. We're downgrading SMH to lab score 4.2, neutral, but decaying. SOXX gained 2.1%, yet our packaging yield model reveals TSMC's CoWoS backlog now stretches to Q3 2027. That bottleneck is priced in, lab score 5.8, pulled with tight stops. SOXL exploded 6.1% on 3x leverage, but the lab's volatility filter just flipped red. Implied gamma demand exceeds ETFs' underlying liquidity. This is fragile. Lab score 3.1, avoid the trap. In the next 8 minutes, we're tearing down the actual chip architectures driving this move, mapping Trump's Phase 2 tariff risk to fab utilization rates, tracking insider selling spikes, and delivering the one semiconductor subsector that's engineered to survive the coming shakeout. This isn't fear. Today, the VanEck Semiconductor ETF, SMH, advanced 1.53%, closing at $436.88. This move wasn't driven by a macro shift, but rather a targeted reevaluation within its core holdings, specifically in the high-performance computing and foundry segments. The primary driver today was NVIDIA. While its weighting remains significant, the market is pricing in accelerated data center capex, directly impacting NVIDIA's GPU demand for AI infrastructure. Closely following, Taiwan's semiconductor manufacturing company, TSM, saw a lift not just from its foundry dominance, but from fresh signals regarding advanced packaging capacity expansion, a critical bottleneck for next-gen chips. Broadcom, AVGO, also contributed, with its enterprise software and networking solutions showing resilience, complementing its semiconductor IP. This combined exposure means SMH's current trajectory is deeply tied to the capital expenditure cycles of hyperscalers and. Welcome back to Denver Stock Lab. Let's get into the DNA of the VanEck Semiconductor ETF, SMH. The fund currently manages an undisclosed amount of assets with an undisclosed expense ratio. While we cannot assess the fee directly, the fund's performance demands a closer look. An astounding year-to-date return of 642.3% versus a 3-year average of 51.2%. This divergence signals extreme recent outperformance, driven largely by its current top holdings. SMH's top 5 holdings, NVIDIA, TSMC, Broadcom, ASML, and AMD, represent an undisclosed percentage of the fund. This concentration, or lack thereof, is critical. If these 5 names truly dominate the portfolio, then any claim of diversified exposure is purely marketing. The lab views this composition as highly efficient for capturing the current semiconductor cycle, heavily weighted towards AI compute and advanced fabrication. Shifting to the technical posture and market narrative for SMH, we observe an RSI of 70.8. This reading firmly places the fund in overbought territory, signaling that the recent price appreciation may be extended. Both the 20-day and 50-day moving averages are converging around $436.88, with current price above both, indicating strong short to medium-term upward momentum. However, the MACD is signaling bearish momentum, which suggests a potential inflection point or consolidation ahead. Now, let's filter the macro narrative. Headlines are dominated by renewed Trump tariff uncertainty, specifically impacting the semiconductor sector, with Intel explicitly named. The lab views this as a critical structural risk, not mere noise. While SMH's marketing emphasizes broad technology exposure, its top holdings, particularly those with significant fabrication or complex supply chains exposed to U.S.-China tensions, face direct revenue. The VanEck Semiconductor ETF, SMH, presents a nuanced structural play. The bull case for SMH is undeniably tethered to the artificial intelligence and 5G product cycles, with NVIDIA and Taiwan's semiconductor manufacturing company, TSMC, as critical enablers. These companies represent not just market leaders, but foundational technology providers for the global digital infrastructure build-out. We see strong earnings from these core constituents as the primary upside catalyst. However, the lab assigns SMH an AI ETF score of 48 out of 100. This score reflects significant structural headwinds. The concentration risk, with NVIDIA and TSMC dominating, exposes the fund to specific geopolitical pressures, particularly U.S.-China trade tensions and export controls. These aren't abstract, macro headwinds. They are direct revenue inhibitors for key holdings. The ongoing U.S. election cycle and China's economic slowdown add layers of policy uncertainty. For SMH. Today, the iShares Semiconductor ETF, SOXX, advanced 2.1%, driven by an accelerating institutional rotation into high-compute infrastructure, particularly within AI. This isn't a broad sector uplift, it's a targeted capital allocation. We see this directly reflected in SOX's top holdings. NVIDIA, while not moving significantly today, remains the keystone, representing the architectural shift towards parallel processing necessary for generative AI. Broadcom's stability reflects its critical role in network infrastructure and custom silicon, providing the backbone for data centers expanding under this very demand. Micron, despite its historical cyclicality, is now benefiting from the surge in high-bandwidth memory, essential for large language models. The combined exposure to these high-leverage components means SOXX is engineered to capture the upside of AI's build-out, but it also concentrates its risk profile directly into the success of that specific technological frontier. Now, let's dissect the fund DNA of the iShares Semiconductor ETF, SOXX. This ETF manages an undisclosed amount of assets with an undisclosed expense ratio. We find this lack of transparency immediately problematic, especially when evaluating if the fee structure is justified by performance. Looking at its top 5 holdings, NVIDIA, Broadcom, Micron, AMD, and Applied Materials, we see a composition heavily weighted toward high-performance computing and chip manufacturing equipment. While these are critical components of the semiconductor ecosystem, the undisclosed weighting prevents us from assessing true exposure. The stated 0% concentration for the top 5 holdings is a clear data error, rendering any diversification claims unverifiable and likely a marketing spin. The reported year-to-date return of 931.9% is an obvious anomaly, likely a data error, which clashes with the more plausible 3-year average of 40.1%. The labs. We're examining the iShares Semiconductor ETF, or SOXX, through the lab's technical and narrative filter. With an RSI of 71.6 and both the MA20 and MA50 at $386.60, the technical setup signals overbought conditions and potential bearish momentum, as indicated by the MACD. This suggests a possible reversal in momentum direction. Meanwhile, the current macro narrative, driven by Trump tariff uncertainty, is casting a gloomy outlook on the sector. However, the lab disagrees with this narrative, as the sector's strong YTD performance, up 931.9%, indicates resilience. We believe the narrative is overstating the impact of tariffs, and the sector's growth drivers remain intact, with the top holdings. We see a compelling bull case for the iShares Semiconductor ETF, driven by the growth of 5G technology, which is a significant product cycle tailwind. This trend benefits companies like Qualcomm and Broadcom, which are key holdings in SOXX. However, we must consider the concentration risk and macro outlook. The current U.S. policy on tariffs and regulation, as well as U.S.-China trade tensions, are impacting the fund. With an AI ETF score of 48 out of 100, we believe SOXX is moderately positioned. Our final verdict is that investors should watch the $367.27 support level, as a bounce from this point could indicate a capitulation signal, especially given the extreme fear reading on the CNN Fear and Greed Index. Today, the Direxion Daily Semiconductor Bull 3X ETF, SOXL, surged over 6% to $76.39, driven by an immediate re-rating of future semiconductor capital expenditure. This isn't just a broad market lift, It's a structural repricing of specific growth vectors within the sector. The move is anchored by key holdings like NVIDIA, whose recent announcements signal sustained dominance in AI compute and data center expansion, directly translating to increased wafer demand. Micron Technology, another significant constituent, is benefiting from tightening supply in high-bandwidth memory and a re-acceleration of enterprise upgrade cycles. Broadcom, with its critical infrastructure software and networking silicon, captures the back-end build-out essential for these advancements. These top holdings, while structurally aligned with growth drivers, also concentrate SOXL's risk. The fund's amplified exposure means that while it captures outsized gains from positive. Now, let's dissect the DNA of Direxion's SOXL. The AUM is not disclosed, which is a red flag for transparency, especially for an instrument of this volatility. The expense ratio is also not provided, but for a 3x leveraged ETF, we expect a premium that needs to be justified by exceptional, consistent alpha. Examining the top 5 holdings: NVIDIA, Broadcom, Micron, AMD, and Applied Materials. It's crucial to understand these represent the underlying SOX index, not direct fund allocations. As a leveraged product, SOXL synthetically tracks this index. The reported 0% concentration for the top 5 is misleading. It simply reflects the fund's derivative structure, not a diversified equity portfolio. The YTD return of plus 1,458.9% versus a 3-year average of plus 68.1% starkly illustrates the compounding. The Direxion Daily Semiconductor Bull 3X Shares ETF, SOXL, presents a fascinating case when filtered through our flow and narrative lens. Technically, the fund's RSI at 71.7, coupled with its 20-day and 50-day moving averages converging at $76.39, signals a deeply overbought condition with potential for a near-term reversal, despite the impressive year-to-date performance. We are seeing bearish momentum on the MACD, reinforcing this technical caution. Now, let us decode the narrative. The prevailing macro headlines are saturated with Trump tariffs and global trade uncertainty, framing a narrative of potential headwinds for the semiconductor sector. The lab's position is that this narrative, while relevant for specific components of the supply chain, largely misses the core driver for SOXL's constituents. The fund is heavily weighted toward fab. The lab's verdict on SOXL is nuanced, reflecting its engineered structure and the current market crosscurrents. The bull case for SOXL is undeniably tied to the persistent, accelerating demand for AI compute at the chip level. This isn't just a cycle, it's a foundational shift in data infrastructure, with NVIDIA and Broadcom positioned to capture significant revenue streams from hyperscalers and enterprise AI adoption. However, the AI ETF score of 52 out of 100 reflects a structural concern. While SOXL's underlying index captures the sector, its triple leverage design amplifies volatility. With the CNN Fear and Greed Index at 16, indicating extreme fear, we are watching for capitulation. A break above resistance at $80.21, driven by sustained institutional inflow, would signal a potential bounce. Until then, the lab advises extreme caution, acknowledging the significant. Today's top signal, SOXL holds with a 52 score. If you found this deep dive valuable, hit like, subscribe, and let us know in the comments what stock you want analyzed next. The lab delivers engineering-grade breakdowns, but remember, this isn't financial advice. It's for education only. Do your own research. Past performance doesn't guarantee future results. We're here to equip you, not lead you. Stay curious, stay sharp. This is Denver Stock Lab, signing off.